Hello, everyone. This is Jordan. Welcome back to the Daily Gold YouTube channel. Thank you so much for joining me today. And we have a Macro Mondays on a Tuesday for you. So I apologize as this is a day late. And there's something really important that I want to talk about. And I have done two videos on this. One was about 7 months ago or so. Another one was over 2 years ago. They didn't have that much traction, but that's not why I'm recording on the same subject again. This is really important to understand. And what I'm talking about is a secular bear market in bonds was underway or has been underway for a few years now. The only other time from 1920 to 2020 that we had a secular bear in bonds was 1965 to 1982. And folks, that was the worst period for the 60-40 portfolio. That was a worse period than 2000 to 2011. It was a little bit worse than 1929 to 1942. It would have been a lot worse if the market crashed like only 70% instead of 90% from 29 to 1932. So that is a synopsis of this video. I'm going to analyze this in charts, but it's so important to understand this. I don't think the market and most investors out there really understand this new era that we're in. So enough of me babbling. Okay, so I've shown this before. It still is a few years old. So the 60-40 has not crossed, you'll see it in the next chart, has not crossed this peak yet. But if we go back and look at history, so we go to, here's the Great Depression, 29 to 42 this time. So here is the secular bear in bonds that I'm talking about, 65 to 82. And then here's 2000 to 2009 or 2000 to 2011. Now this portfolio is rebalanced every year. But we can clearly see here, this was the worst one. I mean, this period was much worse than this period and also worse than 29 to 42. I mean, interestingly, look at the 60-40 portfolio. I mean, this had a huge recovery from 32 to 37. It made a new high. I mean, look at that, it made a new high. And then of course, we have the 37 to 42, which is a very difficult period. But still, at this point, in 42 was actually right at the 29 peak. So that was 13 years in. If we look at this, 13 years after these peaks in the late 60s, I mean, we're here in the early 80s, which is well below the highs. So clearly, when bonds go into a secular bear, and it's only happened one time in the last 100 years, excluding the last couple of years, that's just really bad for conventional financial assets in general. It's terrible for the 60-40 portfolio. I don't think too many people are talking about this. So here we have the S&P 500 total real return. So this is the stock market plus dividends. That's total return divided by inflation. This is bonds, the total return of bonds divided by inflation. I believe in this calculation, I've used the 20 or the 30 or the 10-year bond, one of those. It's a long-term bond data that I have. I'd have to double check it. But so this is the total return of bonds divided by inflation. And here's the 60-40 portfolio, total return divided by inflation. That's what total real return means, including dividends divided by inflation. So then we have gold stocks here, and now we have gold here. And because of my glasses, these great blue light glasses, it's kind of hard for me to see the secular bears that I pointed out here. But here we can see the 66 to 82 or 68 to 82 period, 2000 to 2009. Again, it's clear to see this period, because of its length, was way worse than this period. And this period, it didn't have two 50% bears like this, but it did have, in terms of price, we had one that was 38, and this was 50%. But then you also had, I think, a 20% bear in here, and then you also had this before the period really ended. So again, this is a worse period than this for stocks. I mean, you look at total real return, I mean, clearly this was way worse than this period here. And here's bonds total return. So this is when it all went to shit, excuse my French, for conventional assets, or it would really started. And this is when, again, this is the total return in bonds, and this is divided by the 80-month moving average. So it seems like a long or random monthly moving average. I like to use the 20-month and the 40-month, sometimes the 80-month. This is a case when I'm using the 80-month, because we can clearly see this is where the peak was, right here. It's kind of a double top, and then this is where it lost the 80. It failed here. And again, this is kind of moves at a glacial pace, but this would probably be the confirmation, the failure right here. And you can see here, it was still trending above, kind of lost the 80-month here, but you can see, look at this great bond bull market for almost 40 years. Then it peaked here when interest rates made the bottom during COVID, and then it totally lost the 80-month, and it's kind of recovered a little bit. And if we go into a recession, I do think maybe the 10-year yield will finally go below 4% at the worst of the recession, and you'll get a bit of a rally here. But still, I mean, you had rallies at 65 to 82. You had a rally here. So that's important to keep in mind. So here's the total real return for the 60-40 portfolio. And again, 66 to 82, I mean, 82, you have to go back to, the late 50s. This was almost a 25-year period of no progress for the 60-40. And by this point, or I should say by this point, once you got to the late 70s, this is when people really got out of bonds. The smart money got out much earlier, but this is when the masses really started getting out of bonds. So over here, few people were still in the 60-40 portfolio at that point. And so I just want to point out the huge breakouts in precious metals. Gold stocks here, remember gold was fixed. So this was the way you could buy gold, was through gold stocks. End of 1964, this was a breakout of a 28-year base right here. And then, of course, gold broke out here. Again, greatest breakout of all time. This is out of a 110-year base right here. And here we have today, as far as the time that we're in, here's the big breakout in gold here a year ago, March 2024. So I liken that to the breakout here in gold stocks. It lines up very well. And we can see, again, 64, 65, the stock market still was able to move higher by a little bit, but in real terms, it was done. Same thing with bonds. Again, they peaked here right about the time. It looks like a little bit after gold stocks broke out. Now, the timing here is a little bit different. We had this breakout here in bonds. They really broke down and crashed 2022, so gold was still consolidating. So last thing, look at gold stocks here. This is a 45-year base, the Barron's Gold Mining Index. So this is going to be a huge breakout. That's coming. And I mentioned this on the last chart, but so this is a 60-40 portfolio total return divided by inflation. It's not made a new high yet. So that's because bonds are struggling. So we're looking at the 18-year rolling return of stocks, the total real return here. Then we have bonds again, and here's gold against the 60-40 portfolio. So we can see big breakout here, 2002, and then last month here. And we can see what we're coming up to, how different this bull market could be from the 2000s bull market. So we did have the breakout here, but this is all because stocks were in a secular bear. Look at the total return in bonds. It was still rising. So now we have this falling. Pretty soon, stocks will fall into a secular bear, and then we'll be in the same position we were going into the 70s, where stocks right here, late 68, they fall into a secular bear. Bonds, that already started. It already started in 65, although you could put the signal here right around the same point, 68. But last thing I want to mention, you may think that stocks will save you and hedge against inflation, but over the long term, they will not. And this chart is exactly why. We're focused on this period here, and this is the 18-year rolling return. And look what happened. This was around zero from basically the very end of the 70s to the early 80s. So once you got to this point, your return over the last 18 years, if you held stocks, total real return was around zero. And we can see here, if we're just looking at this and we're looking at the lines, at the 82 low, this was, I should have put a line here, but basically this 62 peak here, right around the same level as this low in 1982. So I think we're going to repeat that. The question is, where's the starting point? This is probably the starting point right here. this peak at the end of 2021, let's call it 2022. So you measure this forward, and I bet the late 2030s, maybe 2040, that 18 years, we're at a level right here that's the same. Because that is what happens in a secular bear market in bonds. And look, I mean, if you could go back and look at this, and you may think you're okay for a little while. You're up here. Oh, we had this 38% bear here, but we recovered. Oh, now we're back at the high or back to a new high. Everything will be okay. Boom, 50% bear market. Oh, we recovered. Here's 76, the 200-year anniversary of the country. And no, we're going to keep recovering. And then it just goes sideways. And you're like, oh, shit. Now what? Now it's gone 12, 13 years. I've had zero real return. So that's what happens. This is important to understand. It's going to take some time, but this is deadly over time. And it's worse than a stock market crash, because during a stock market crash, those only happen when bonds are in a secular bull, because the market crashes because people dump their stocks and they'll say, oh, I'll just get 3%, 2 or 3 or 4% in bonds. If they're going up, they're safe. I'm going to do that. So that's a big reason why you have stock market crashes. But when bonds are in a secular bear, you don't have those. But when they're selling stocks, the money that would buy bonds, that's going into gold. And that's why you get this. And that's what's coming here. So that's all for this video. I know I droned on a little bit too long, but thank you so much for tuning in. Leave a comment. Let me know what you think. And I'll see you guys again in the next video.